Hello and welcome to your Monday Futures Market Outlook for June 20th, 2011. This is Patrick Sresna. For those of you that have not had the opportunity to try our eminisource.com trading room, 5-day complimentary memberships are available on the website. As always, we start off with a weekly chart of the S&P 500 going back 3 decades, and we plot an 80-week moving average on there. It does a very good job to depict the bull and bear market cycles that the market has gone through. We've been looking for a short-term market high to come in up around this 1350 to 1400 area on the upside, and subsequently a correction to resume. And we basically have now gotten that. In that blue box, we marked off that area where there will be some very important information given to us in regards to whether this is simply a corrective pattern within the normal bull market cycle, or whether or not we're going to start a more ominous bear market. And at this stage, there simply isn't enough evidence for that, but we are anticipating a lot of very important information to come around this 1200 to 1250 area on the S&P. Let's take a look at our key intermarket observations. First of all, there is not enough evidence to change our intermediate bullish bias on the broader market, even during a period like a market correction. The market itself can stay relatively bullish in terms of primary trend. While we have significant confidence that the second quarter highs are in, and maybe the highs of even the year, the bottom line is that so long as the bulls hold the support lines as we come in around these 1200, 1250 areas, we could still see a bullish reversal come the third quarter and subsequently a rally into the end of the year. At this stage, what we're looking to see is whether the US dollar has put in a short-term low. If we have, then that should continue to deteriorate commodity prices. We've been looking for that big intermarket shift to occur from an asset class rotation perspective of short stock, short commodities, long bonds, long US dollar. That scenario has been playing out. The only question now is this just a multi-month reversal, or is this a bigger picture shift that will take place over a course of 6 months or a year? We will find that out over the next month or two into July and August, and we'll make the observations from there. Next year, we're going to take a look at the S&P 500 using that E-mini futures contract. We've been looking at that 1250, 1260 focal point as support on the downside, and we've now consolidated all of last week right at that level. At this stage, we do believe that some sort of a short-term swing bottom should come in the market, either off the existing level where we're at, or even just one more good thrust downwards towards 1240 or 1220 area on the downside, and then subsequently we should begin a 1 week or multi-week retracement back up to retest the upside that will more than likely look like a flag or a wedge. It will be after that rally that will determine when we will, whether or not we're seeing a market correction, or whether this is going to be more of a bigger picture bear market. But at this stage, we are looking for a short-term low somewhere down in here. Next year, I want to take a look at that U.S. dollar index futures, and you can see that we bounced all the way back down to previous lows around the 73.50 area, put in what now looks more like a double bottom, and traded all the way back to the top end of the trade range where we consolidated the 76.50 area. This will be a very important moment for the U.S. dollar. Either the U.S. dollar is going to remain relatively range-bound and trade back to the bottom end of the ranges and then stay back and forth chopping, or it's going to make a legitimate push to new highs. If we have it reverse and break above this focal point at the 76.50, it may begin a U.S. dollar rally that may not stop until the 78.50 area, where all the top end of the retracement zones lay. Next year, I want to take a look at copper futures, and overall, copper continues to seem very toppy. We were talking about this flagging formation, and even though there were short-term pops higher, overall, there continues to be deterioration. Any break of this $4 level along these lows, where marked off that blue line, would still indicate that copper has to come down and retest these lows around the 370, 380 area. This would be certainly given a very good push if the U.S. dollar managed to have a very strong rally up here. Next year, I want to take a look at gold futures, and we've been talking about this rising wedge in gold. And gold, no matter what, doesn't seem to want to give out. It's the only actual commodity that has really held up near its highs. So many of the other commodities have already considerably weakened. So the fact that gold continues to hold up, we have to make that observation that there is some technical strength here. Overall, we were looking for technical weakness to continue to deteriorate gold down toward 1420 to 1440. But as we see all of the other commodities break down, if all of them finish their moves on the downside without gold ever having made the breakdown move, then gold may actually not be maybe the one commodity that does not actually correct fully downwards, but rather more sideways during this cycle. Next year, I want to take a look at silver futures on the continuous contract, and you can see that silver has corrected far greater than gold. It's not only had a very steep reversal, but subsequently it failed on a flagging formation right into that retracement box we drew. Now at this stage, with it looking like it's rolling, there's a legitimate chance that silver still finishes its move right down to the consolidation points where it was in December and January earlier this year. That would mean that any break of the 34 level, we could see a retest at 32 and even as low as 28 or 27 on the downside. Next year, I want to take a look at crude oil, and crude oil futures really have rolled over far faster and quicker than we have seen in all of the other commodities, while copper, silver, and all these other metals have just been sort of looking toppy like they want to roll. Oil has really gotten underway on this move lower that we were anticipating. In fact, oil has already completed a shortened move. While we certainly cannot rule out the possibility that oil finishes this move all the way down to retest that 85, 86 zone on the downside, we were only looking for oil to get down to here. So by all accounts, if oil was to make a very dramatic reversal off of this level, we would consider it to be a completed move down. But that doesn't make me bullish on crude. In fact, we could still see $5 on the downside of crude wiped out very quickly. But we will be looking for some sort of a short-term low in crude somewhere down along these lines. Finally, I want to take a look at that 30-year Treasury bond, and it looks like it wants to technically break this 126 handle and actually make a break higher. The next good support or resistance level up above is around the 129.5 to 130 area on the upside. We'll be watching to see whether or not the bulls can follow through on the Treasury bond breakout, but be warned that any false start on the upside that immediately reverses back down may actually be creating a short-term topping formation. So we want to trade higher with these Treasury bonds if it breaks, but be warned of any immediate reversals of a breakout. That was your Monday Futures Market Outlook. Thank you for joining me.